Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
To discuss, Ed Yardeni of Yardeni Research joins us now for more. Ed, welcome to the programme, sir. Can this market, as we've been discussing, have its cake and eat it too?
It's doing it right now for sure. We've had a very strong bull market really since October of 2022, and it hasn't stopped. We had a correction at the beginning of the year related to uncertainty about Trump's employment policies for the government with DOGE and uncertainty about tariffs. And so naturally, if you're an employer, you're going to hold off on hiring and not necessarily fire anybody. And so I think a lot of the soft patch, which is I think what it's been, is related to uncertainty. And I think the markets are starting to conclude that, you know what, uncertainty is going to be with us here for a while. Let's move on with our businesses. And I think the economy is in good shape.
The enthusiasm is starting to spread beyond the big tech story. 2 days of really decent days of gains for small caps. Now, Ed, whenever this market participants get a sniff of outperformance on a small caps, the excitement starts to build again. Is this another head fake or the real deal?
Well, you know, we've had lots of head fakes in that regard, really, since 2018. Roughly around then, we did see that mid caps consistently underperformed the large caps, the S&P 500. I'm looking at the S&P 400 mid caps, the S&P 600 small caps. They just kept underperforming. Every now and then you'd get a head fake, and I won't be surprised if this is another head fake. I'm not telling anybody that it's not tradable. I think clearly it is tradable, as previous head fakes have been, but they don't last very long. And the reason is that earnings of the small cap, mid cap companies just continue to be in a coma. They've been flatlining since 2018. And I think they're doing that because the good ones keep getting bought out by the large caps. So you never really get a situation where you can buy a small cap and have it turn into a Microsoft.
If the Fed were to cut by 50 basis points next month, would you change your view? Would you see this as something other than a head fake?
Well, I think then I would just say we're in a melt-up. I mean, it feels like a melt-up already. We've seen this, the correction at the beginning of the year. We've seen multiples go from 22 forward PE for the S&P 500 at the beginning of the year down to 18. We didn't get down to 15. We didn't get down to 10. The market figured out and kind of agreed with me that the economy was resilient and we're not going to have a recession. And when it did that, suddenly, boom, we went right back up to 22. And so the market ain't cheap. And the reality is if the Fed cuts when there's still, as you said, a lot of ambiguity about whether it really needs a cut, it doesn't really need a 50 basis point cut, let a 25 basis point cut. The administration needs interest rates to come down because they'd like to see the interest costs of the debt come down. But the economy, I think, is going to surprise everybody in the next few months, especially the consumer, as you also indicated, and show some resilience in the consumer part. And capital spending, a lot of it is technology related. That's going to continue to go. So I think, as the drums beat for more rate cuts here, and we're probably now going to get one in September, and then there'll be expectations for another one after that before the end of the year, I think we're in a melt-up situation. So, right now I'm still kind of sticking with 6,600 on the S&P 500 by year end, because I think there's still a couple of indicators here that might suggest that maybe the Fed shouldn't be lowering rates. But absent that, we could go right back to 6,900, 7,000 by the end of the year on a melt-up situation. And the problem with melt-ups is they're followed by meltdowns.
Well, that's where I wanted to go, Ed. This is something that you talked about a couple of months ago, that you're worried if the Fed cuts rates too much, you could end up with a bubble, and that you could end up with a late 1990s type scenario that leads to the meltdown that you are referring to. How close are we to that if we do get the series of rate cuts that the market is currently pricing in?
Well, before we go there, let me also point out that at the end of last year, I also felt that there was no need for the Fed to lower interest rates. And I said that if the Fed did lower interest rates, bond yields would go up. Little did I know that the Fed would do 100 basis points, all told, at the end of last year. And guess what? The bond yield went up 100 basis points and frustrated all those people who want to see mortgage rates come down and corporate rates come down. So the Fed eased, but the bond vigilantes tightened. And we have that possibility again now. So just because the Fed eases, let's watch what the bond market does. It may not be very happy with the Fed moving to lower interest rates when the Fed's been telling us for a long time that they need to get their inflation rate down to 2%. And right now it's closer to 3% than 2%. But yeah, I mean, a 1990s style scenario is a possibility. I mean, right now AI looks like it's on a much firmer footing with earnings than we saw back in the tech wreck that occurred in the late 1990s, early 2000s. But in this market, you never know. I mean, DeepSeek came out of nowhere in January and created a pretty nasty correction.
Deep who? And then we bounced back pretty quickly, didn't we, Ed? That's the stock market.
Yeah.
I want to tease out what you just said about the bond market. Do you see then a similar backdrop this time around to what we saw take place back in September?
Unfortunately, I do. I think that the bond market is not going to like the Fed kind of caving into political pressure and easing. I mean, I think a lot of Fed officials are probably on the fence, but they're getting pushed over to the easing side by the political pressure. And that being the case, I think the bond vigilantes, that's what the bond vigilantes are supposed to do. They're supposed to maintain law and order in the credit markets and in the financial markets and the economy if the sheriff decides to go out to the saloon.
Not seeing much law and order right now, Ed. Appreciate your time. Ed Yardeni of Yardeni Research. Former senior US intelligence official Norman Roule joins us now for more. Norman, welcome back to the programme, sir. Is the president in a position to negotiate on behalf of the Ukrainians?
Good morning. He is not in position to negotiate on behalf of the Ukrainians. The Ukrainian president has made that clear, and the Europeans have done everything they can to send a unified message that Ukrainian territory is not something the president can offer in his talks. And in fairness, the president has stated that he is not going to offer Ukrainian territory to the Russians, and indeed will be doing what he can to acquire Ukrainian territory that Russia has occupied to return back to Ukraine itself. The question is, how exactly does he do this? And indeed, in terms of the severe consequences that he would apply to Russia, that in itself requires some caution, because to do that requires secondary sanctions on China and India. And as Secretary Bessent has stated, that would require European cooperation, and Europe has not been very enthusiastic about cooperation in that regard in the past.
Norman, there's a lot to unpack there. I want to get into the ceasefire agreement that President Trump has talked about as a threshold to cross in this meeting tomorrow. What would that look like given the previous ceasefire agreements that already have been made and broken?
A ceasefire agreement is unlikely. President Putin has violated most of those agreements, and right now we're watching each side do what they can to demonstrate strength. The Russians are conducting a series of ground operations that are allowing them to make short, sharp advances in the Donbass. The Ukrainians are conducting drone attacks on Russian energy facilities, which are important given that Russia's economy is contracting further. Per the IMF, we'll have only 0.9% GDP growth this year. So we're unlikely to see a ceasefire take place unless each side is convinced that a peace deal is likely. And again, we have no evidence for this in the near term. This said, the president is going to be doing his best to achieve that. And we're likely to see one-on-one meetings with President Putin and President Trump. The Europeans will be concerned about that. They have demonstrated that concern, and the president has demonstrated in the past that his relationship with Putin is very personal. and he sees that personal relationship as where his strength lies in achieving an agreement.
There's a question, Norman, about whether the president really has as much leverage as he could if he's going into this without the Europeans agreeing to helping to enforce the secondary sanctions. Do you think that this is premature? Do you think that this is a good timing on the part of President Trump to go at this alone, given the lack of cooperation on some of the more punitive parts?
Well, to be clear, I'm not sure that the Europeans are ever going to be enthusiastic about supporting secondary sanctions on China and India. And at the same time, Russia's Russia's economy continues to contract. It has contracted. The IMF has reduced its projections for GDP from 1.5% to 0.9% for this year and next year. 40% of Russia's economy is now devoted to military spending. It's likely to remain that way for the future. And Russia is losing a vast amount of personnel every day. The president sees this. I would expect that his private intelligence and economic briefings show a dire picture for the Russian economy. And he probably sees this as his lever over Vladimir Putin. So although Putin will come in playing a strong hand, trying to show battlefield gains, trying to show that he's going to win this war, I think the president's position is going to be, look, you're a big country, an aging population, you've got great resources, you could be doing great things in the world, but you're driving your country into the ground, and the best way for you to save your country's future is to end this conflict. I think that's probably going to be the tactic the president may consider.
Noam, do you think that tactic will work?
I doubt it. I think Vladimir Putin is a map changer. He is committed to changing the role of Russia, to restoring the Russian Empire, the Soviet Empire. He doesn't believe Ukraine should exist as a country. I think he's committed to the maximalist gains. He may offer some sort of territorial concessions to restrain sanctions. He may try to delay further sanctions. We also have arms talks that Vladimir Putin may hold out. And nuclear talks are something that we no longer raise in our discussions, but are tremendously important. And I think Vladimir Putin may hold out nuclear talks and Arctic cooperation as some way to continue engagement with the U.S. That may complicate the relationship. And again, you don't hear nuclear talks and Arctic cooperation as something of great importance for Europe, but they are of importance to the United States for our national security.
Norm, what I hear from you is this doesn't end without compromising the integrity of Ukrainian territory. Now, I just wonder, with that in mind, Norm, how you think this does end, or will it end? And if this can just continue for years on end?
This ends when the Ukrainians decide it ends. That's not a decision the American government can make. This ends when the Russians decide it ends. Again, that's not a decision the Americans can necessarily make. But at a certain point, any deal that does come about in the end is probably going to leave each side unhappy. And the U.S. government has communicated on a number of occasions that if there are going to be territorial decisions made in the end as part of a peace agreement, it probably would involve concessions on each side that will leave each side unhappy. That's a tough thing to say. And obviously, Ukrainians who have given blood are going to be unhappy to hear that. But that has been a previously stated U.S. position. But again, that's a Ukrainian decision to make. And it's not a decision they're going to make at present. And it's a decision they won't make unless they're at the table.
Norm, thank you, sir. Appreciate your thoughts. The former senior U.S. intelligence official, Norman Roule, with some sobering words there on the future of that war. Joining us now to discuss is the former World Bank President, David Malpass. David, my good friend, welcome back to the programme, sir. Let's talk about the leader of the Federal Reserve and the next Fed chair. What are the characteristics that we're looking for here, David, in the next Fed chair?
Hi, John and Lisa. I think what is needed is a lot of change at the Fed. So the characteristics are someone that will bring change and really confront the PhD economists that have been running the Fed. You heard some of that in your previous guest talking about the bond market vigilantes and the parent we all need. So I think getting the Fed out of the way of the market and creating the rationale for a much lower interest rate curve curve along the curve, I think that's what's critical. I was very happy to see Secretary Bessent yesterday talk about two things. One is the 50 basis point cut possibilities, and also the need for foundational change at the Fed. That, to me, means more loans for small businesses. So that's going to be one of the opportunities for the U.S. as we change the supply chain.
You said in some of your previous comments that the Fed is using old models that are wrong on economics. Which models in particular do you think are incorrect?
There's a long list. How long do you have? The Phillips curve doesn't work. The idea of ample reserves doesn't work. The idea of inflation targeting using backward-looking data doesn't work. There's a big opportunity there. If you used forward-looking price-based data, you could get lower interest rates, and the market would welcome it. That's what we saw yesterday, I think, when the Secretary said foundational change. There are better ways to do this than what the Fed has been doing. They lean against growth, Lisa, and that's been part of the problem, that when the economy gets going, they say, oh, that's overheating, when actually that's what we want. That's the goal of economic policy, to have non-inflationary growth.
David, a lot of people would say that when they don't tamp down on inflation, it's been asset price inflation that's really run away, and that has led to a number of pretty significant crashes. What are you pointing to in particular in terms of practical consequences that point to some of those policies? I mean, what do you think the growth rate should be in the United States right now if the Fed were using the models that you would like to use?
I think the growth rate can be comfortably 3% real GDP growth, maybe 4%. The Fed has a potential GDP speed limit. They just published on June 18th the idea that it should be 1.85% per year. So that just doesn't make sense given the possibilities of regulatory change, the recent tax stabilization. So they took the tax cut, the tax increase that Biden was planning and Biden-Harris were planning, and took it off the table. So that allows businesses to begin investing for the future. Lisa, the Fed has perpetuated this idea ever since Paul Volcker that high rates are the way to bring down inflation. The reality is more production is the way to bring down inflation, and Trump's doing that with all the changes going on in the economy.
David, I'm happy for people to make the accusation that perhaps this Fed chair has been reckless with monetary policy, but I'm far more sympathetic to the idea that he's been recklessly dovish. This is an individual that led a Fed that let inflation absolutely rip. This is an individual that saw markets doing okay, equity still close to all-time highs, and cut interest rates 100 basis points. David, can we really make the argument that they've been recklessly hawkish?
Yes, they're hawkish right now, and look at the difference in the environment they were cutting into. It was politicized in 2024. There were heavy regulations stopping business. There was no investment going on, and yet they were cutting, thinking that inflation was transitory. What we have now is a big change going on in the economy, and I think the opportunity for capital to flow into the U.S. As you make the economy stronger, you're going to get support for the dollar. And again, we have to look at how the markets reacted yesterday favorably, whereas when the Fed was cutting during 2024, markets reacted unfavorably. So there's a huge difference.
Look at the difference between the market right now, though, and what the Federal Reserve is ultimately projecting. David, I don't think there's too much daylight. This is a market and a Federal Reserve that seems to be on course to cut interest rates somewhere between 100 and 150 basis points. What we heard from the Secretary of the Treasury yesterday was they need to cut from 150 to 175. David, I understand this should be a healthy debate, but is there really that much controversy between what the administration would like to see and what's ultimately being projected by both markets and the Federal Reserve alike over the next 18 months?
I think that's useful. The markets are looking at what's going on in the economy and realizing that there can be a lower interest rate environment for the United States across the whole yield curve. I think that's important, and that adds to growth. Look, the goal here is a virtuous circle where capital flows in, where growth goes up, and production goes up, and that brings down prices. So then you can keep doing interest rate cuts. You get a virtuous circle. I think that's possible. It's going to be really important for the Fed and PhD economists to get to realize that their models haven't been working over the years. We've had these wide swings in inflation and deflation and interest rates because the Fed's looking backwards. And so we need new models, sweeping change in the models. That's been what I've pointed out, and it will benefit small businesses. That's the key.
David, looking forward and using your models, what do you think the neutral rate is?
I think the neutral rate is lower than where we are now. You know, the Fed keeps saying that the interest rates are appropriate right now at 4.4%. How do they know that? They're the ones setting that rate and paying banks, a lot of them international banks. 40% of the money payout by the Fed is going to international banks, and they've paid $1.3 trillion since they started paying interest to banks. So they're affecting the markets, and they don't know what the neutral rate or what the bearable rate is.
Well, to be fair, David, no one knows, as you know, but they're taking a stab at it. They think the longer-term rate's something close to 3. So what do you think it is? Close to 3 is like 150 south of where we are at the moment. What do you think it is? How much lower than that could it be?
I think the strength of the U.S. economy justifies lower rates across the curve, substantially lower, and the market is looking at that and already beginning to price that in. And it's part of the favorable environment being created.
I think we've lost the connection with David Malpass. I was quite enjoying that, and I know David was too. A spirited conversation with the former World Bank President, David Malpass. With us around the table, Nela Richardson of ADP, just to break down where we are in the economy. Nela, let's start with not just the data this morning, but the setup at the moment. As you look across your dashboard, what do you see?
Well, what we're seeing is an economy that continues to chug along. Hiring momentum has slowed. I think that's clear. There's been some stasis in the labor market. But overall, when you look at the things that I look at, like, are companies cutting hours? No. Are wages plummeting? No. Actually, they're staying pretty well formed and really, really steady. And so even though we're seeing a slowdown in the momentum, the underpinning of the labor market continues to be solid enough to support consumer spending. Now, we'll get retail sales out in a bit. We'll get some confidence data out in a bit. This inflation surprise is something that should be considered with a whole bunch of other data that was leading up to this point showing no smoking gun when it came to tariffs and inflation. So the big picture is it's an economy that continues to perform. It's just not as dynamic as we're used to seeing. Ira Jersey of Bloomberg Intelligence is just working through the details of that PPI report. I'm going to cross over to him in just a moment. Just to come to you just quickly on what we're seeing with inflation. Is it too early to draw conclusions here based on the data we've had so far? And will it be too early at Jackson Hole, too early at the next Fed meeting? Some conclusions are going to have to be drawn because decisions have to be made. But it's really going to be a matter of perspective. So those components, as Lisa mentioned, of the PPI are going to be so important. Because when we looked at the CPI, the inflation triggers were all in the services. It wasn't like the goods sector was screaming inflation. Those final goods aren't showing it yet, at least yet. Those intermediate goods, the wholesale goods, that's where a tariff could bite in the, as the goods are being built and formed. And we might see that in the wholesale prices and the producer prices an increase. So maybe this is the first sign. Maybe it's just a one-off. We won't know, but we have to look at the complete complexion of the economy, at least some people do, in order to make those rate decisions next month. We're trying to do that right now. We can do that with Ira Jersey of Bloomberg Intelligence. Ira, you've been looking through the details, sir. What stands out to you? What's behind this big upside surprise this morning?
Yeah, so it's not necessarily the goods sector that's driving a lot of this. So you saw a big increase in the services PPI here with a 1.1% increase month on month. That was negative a little bit last month. So you had this big shift toward services increasing, in particular trade. So some of that could be from import prices. If you think about the pass through from shipping and things like that are going to be goods that are going to be tariffed. So maybe this is suggesting that there might be a little bit of margin contraction. And like you mentioned, not a huge move in the front end of the bond market, but it's still 5 basis points from where we were right before we received the number. I think retail sales tomorrow will wind up probably being even a little bit more important to the bond market than this particular number. But certainly, 50 basis point move in September might be taken off the table with worries about inflation ticking up a little bit here.
It's not just that, Ira, and I'm glad that you broke it down and understood to see that it's coming from services kind of mimics what we saw in the CPI. It's also the initial jobless claims coming in at the somnolent 224,000. Even continuing claims came in a touch. These are the people who keep receiving unemployment benefits. Where is the impetus for the Federal Reserve to need some sort of emergency rate cut, given the fact that this doesn't seem to point to any kind of massive dislocation in the labor market?
Yeah, keep in mind, the claims numbers have been relatively steady for years now, but so remember that's only one side of the equation, right? That's the firing side. So it's really how many new people are entering the workforce and are going to be then hired by firms too, because at this kind of pace, you'd wind up with pretty massive layoffs actually if there's not someone hired on the other side of those initial jobless claims. And you have seen a slowing in that. So it has to be the job market, right? The Fed to cut more than 25 basis points in September would require a really disastrous kind of non-farm payroll number, I think. Now, that being said, just the slowdown in the hiring process without consumer prices ticking up quite a lot, that could mean that, hey, the Fed could ease just a little bit to kind of placate the market, make sure that the job market doesn't completely fall out of bed. And I suspect that that's the thinking of those members like, Governor Wallers and Bowman, who have seen this slowing in the job market and are concerned that it could get worse. So let's be a little bit proactive here. Now, that being said, do they have to do that? I don't think so. Like we had always had penciled in based on our forecasts in October as the first rate cut. But realistically, September versus October, it's not going to matter that much to, 10-year Treasury yields, quite frankly.
Ira, just before you go, I've just got a brief question, and it's to build on what Lisa and I were talking about at the front end of the curve. Why is this market looking through firmer services inflation, both in CPI and PPI this morning? Why are we only up by a basis point or two? If you told me these numbers earlier on this morning, I might have guessed, might be up double figure basis points off this, maybe up 10 basis points, 11, I don't know, but not a single basis point.
Yeah, well, I think that the CPI report wasn't nearly as bad as I think the market thought, and the market is certainly pricing in for a modest easing of monetary policy over the next couple of quarters, and and again, like as long as you wind up having a slowdown in the economy, the Fed is going to try to right size things, and there is this idea that within the market, and I've talked to a lot of market participants about this, where is neutral, right? I actually think we're pretty close to the neutral rate, but a lot of people disagree with me and believe that the neutral rate is closer to 2 or 2.5, which is where headline inflation more or less is right now on a CPI basis. So people do think that rates are still restrictive. Again, I'm not as convinced of that, but that's where the market is, and that's why the market thinks that the Fed is going to be cutting rates in the very near future.
Don't fight the market. It's always the lesson. Ira, thank you, sir. Ira Jersey there of Bloomberg Intelligence breaking this down. Lisa, services again. Firmer.
This isn't necessarily a good thing for the Federal Reserve because typically services is something that's more discretionary and tends to be more fungible. It raises this question about where the weakness is coming from. Nela, I have to say the ADP report's taken on a lot more import recently, especially with some of the questions around the BLS. And I just wonder what kind of hiring you see in services and wage increases to edify the sense that that's an area that's actually been benefiting of late.
I think the issue with the labor market is that the structural and the cyclical are kind of colliding in this moment, because we are still in a labor market that's being impacted by the pandemic. We're being impacted by an aging workforce. We're still being impacted by the Great Resignation, which means the turnover, that dynamism is missing in today's labor market. So when you look at something like services, what are you seeing? Well, first of all, you're seeing certain pockets of services slow down tremendously. We saw a dip over the summer. It's rebounded according to our data in the last month. New entrants into this market is very slow. If you talk to any parent of a college-age student, it is, my student is still looking for a job, even though they just graduated. If you look at ADP data, if you don't like the anecdotal, you want to look at the hard data, we pay over 25 million workers in the United States, and what we're seeing is that new higher pay hasn't budged from $18 an hour for the median in more than 13 months. So there is a stagnant part of this labor market when it comes to onboarding new people. That's going to be reflected in productivity numbers, and it really is going to impact services more than goods. Goods sector, that talent tends to be more specialized, fewer new hires, less affected by the people dynamics that underpin the labor market.
Can I ask you a provocative question? Is the new BLS chief good for business? Which I think is what Lisa was trying to ask. Is the new BLS chief good for business over at ADP?
Well, until they're confirmed, we won't know. But what I can tell you what's good for business is good data.
Nela Richardson of ADP.
Very diplomatic.
Thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.